In this video, I'm going to talk about the 3 major mortgage qualification principles that will help you qualify for the maximum mortgage possible and at the best possible terms. Throughout the course of my 17-year career as a mortgage broker, I've seen thousands of applications come across my desk, and I always wanted to create some sort of blueprint or a template that could summarize what the driving forces are or the key contributing factors that lead to 100% mortgage approval ratings. So I've looked at several of my files over the years, and I've noticed a few key and core principles that lead to highly successful mortgage applications. And I'm going to summarize that for you in the following 3 points. Okay, principle number 1, be absolutely forthcoming with information throughout the entire qualification, mortgage application and qualification process. So number 1, be complete and as accurate as you can possibly be throughout the application. So in some instances, be brief where you need to be brief, but in other parts of the application where you feel more detail may be required, go ahead and do so. There's always an extra notes section that you can provide more information within an application. Of course, you can pick up the phone or text or email your mortgage broker and provide more detail to them. So this could be anything. This could be perhaps addressing why there's a skip in your employment, or maybe you've moved around a lot in the past few years. Provide an explanation. So you never know. The more information we have, the more option of outcomes that could result in your mortgage qualification. Okay, principle number 2, provide quality verification documents. Okay, so what I mean by that is quality in terms of the document itself plus the content in the document. So let's start with the quality of the document. Provide documents in their entirety. So if a lender sees a document that came in and it says page 1 of 3, but we only received 1 page, the lender will ask for the remaining 2 pages. So please submit the documents in their entirety. Number 2, if you're using your camera, that's fine, but just make sure the resolution is good and kind of be the judge for yourself. Like before you send that photo, make sure it is legible, because a lot of times they aren't. But if you receive a document list from me, for example, where there's an upload portal, the technology allows you to, if you open the document list from your phone, you could take a picture of your document and automatically uploads into the portal. And what it does is it gets converted to a very legible, high quality PDF document. So that's absolutely there. If you're in a position where you have to use your cell phone, just make sure reach out to your broker to ensure that the quality will not be compromised. And whenever possible, avoid like multiple piecemealing submissions of document submissions. So this could be very annoying to the lender. It could also increase the margin of error for your file. By doing that, for example, it could be a 20-page document and there could be 20 separate attachment JPEG files that you've taken from your phone. Something could slip through the cracks. And that document could be presented to the lender as a 17-page document, but it was really supposed to be 20 pages. And you want to avoid that. It'll cause headache either early on in the process or worse yet at the 11th hour. So avoid that whenever possible. And finally, the content quality of the actual document itself. So just be aware that lenders are requesting very specific documents to verify very specific information within the application. So a lot of it really common sense. The biggest one, the flaws or the hardship that we see, the biggest challenges are during down payment verification, where the quality of the document, mainly the content, really comes up. And the big ones are there's no proof of ownership. and the actual account number. So the name of the applicant and the account number. So a lot of times we'll get documents where you see the sum of the down payment. We see that verified in the document, but nowhere in the document will there be the name of the applicant and the account number. So there's millions of ways around that, how you can get that. And one of the most common ones is online bank statements. So either do the screen capture thing, take a big picture of the screen, and we'll be able to see the ownership and the account number line up with the down payment verification. And finally, principle number 3, don't over obsess about the interest rate of your mortgage. Okay, like it is an important factor, of course, don't get me wrong, but don't over obsess on it, because if you do, you could be overlooking other critical and important terms and conditions within your mortgage. And the first one being the formula that's used to calculate the break penalty of your mortgage. They vary significantly from lender to lender. So be aware of that, and ask your mortgage broker or banker to explain what the formula is to calculate the break penalty of your mortgage. Another thing that could vary or outright just be compromised within the mortgage terms and conditions is the ability of your mortgage to transfer to another property in the event that you sell ahead of your maturity. So it's called portability, mortgage portability, and it's a neat little feature and could save you thousands of dollars if you do sell your house or discharge the mortgage prior to the term of your maturity. So another thing worth looking into. And also there's something called prepayment privileges, and this is a kind of a summary of all the opportunities that the lender gives you throughout the course of the year to pay down your principals more aggressively without any sort of penalty at all. So that's another thing that could be compromised within the terms and conditions of your mortgage. So again, review those prepayment privileges with your mortgage broker. And another one that we're starting to see more often is there could be some sort of condition that here's your interest rate, but to get this interest rate, one of the conditions may be that you may have to set up a daily checking account with that current bank that offered you that interest rate, which is all fine and dandy, but just be aware of that up front and understand the action that you must take prior to closing your mortgage to complete that condition. So worst case scenario, you don't want to be presented with that information at the 11th hour at the lawyer's office when you're signing off on documents to be told that, oh yeah, by the way, to get this amazing rate, you have to have a checking account with our bank. So make sure if that is a condition, be aware of it up front and take the necessary action to fulfill it so you can get your amazing rate. Okay, on the flip side, there are also other things to be aware of, not just within the terms and conditions of the product, but the peripheral offerings of the lender of the mortgage. So, for example, some lenders have amazing online portals where you can service your mortgage online. And there's a ton of other fancy calculations and calculators that are available on these sites as well. So this may not be important to you, but for many it is, because this service is so convenient and so easy to do that for some people it could be the difference of actually making an extra payment and on your mortgage towards a principal, and over the long term saving you thousands of dollars and paying your mortgage off quicker. So it's amazing when you provide that opportunity to someone to actually change their habits. This may be the difference for some to actually go forward and actually increase their payment by $25 every week and knock off 5 years off their amortization. So look for online servicing capability with lenders as well. Other lenders offer this real cool feature. It's called readvanceable mortgages. And what that allows is, for example, every mortgage is basically principal and interest. And with the readvanceable mortgage, as you pay down your principal every month, let's say you're doing monthly payments, as you're paying the principal down, it's becoming available to you in the form of a home equity line of credit. So let's say 5 years down the road, you've paid down $40,000 of your mortgage principal. You'll have access to it. So in the form of a home equity line of credit, which could you either get that in checkbooks or a debit card. But otherwise, if you wanted access to that equity, you would have to call your mortgage broker or your banker and do a refinance, potentially trigger a penalty, and so on. So really cool feature, readvanceable mortgages. Look into it. Some lenders also offer like a built-in refinance program. So what that means is, let's say you have a 5-year fixed and you're 2 years in, and you're like something happens, or some debt, you need a debt consolidation, or you need an extra 20,000 to buy a new car, whatever. Typically you would call the lender, you would do a refinance, you would break your mortgage. That would incur a penalty, and hopefully things would work out. But with this built-in refinance program, it can leave the existing mortgage intact, and you can just add a second mortgage component to that. All right. So it's not the second mortgage that you may be familiar with when the term second mortgage comes up with. It's not the high interest rate, the crazy fees and so on. This is a second mortgage built-in program with the existing lender at very reasonable, fully discounted interest rates. Another thing is some lenders may offer extended amortizations. So many of the lenders have standardized on 25-year amortizations. However, some lenders, and this could be a difference for some, you may want to jump up to a 30-year amortization. And we're seeing more and more of that these days, and mainly for the purpose of reducing their overall monthly cash flow. So by extending your mortgage from 25 years to 30 years, you're going to have a lower monthly payment. So look for that as well. Look for that. And as I discussed above already, but I need to reiterate this, the break penalties. They vary significantly from lender to lender. So again, ask your broker or your banker to explain the formula of how the mortgage break penalty is calculated, because this could be a game changer. You never know what life throws at you. You may be forced to sell your house, or get a career opportunity. You have to move to another location or whatever. You don't want to be caught, with that hefty mortgage penalty. But had you known, maybe the other lender that you were considering at the time had much more favorable terms when it comes to the break penalty. So look into that stuff. Okay, so that's basically, like, to summarize this final principle: don't obsess on the interest rate alone. Very critical. So check out the terms and conditions of the product itself, and furthermore, expand the research further and look at the peripheral offerings of that particular lender as well. So a lot of pluses in there, and at the end of the day, if it's a difference of 1.69% or 1.64%, the best price doesn't always win. So just be aware that whatever the difference is in the interest rates that you're being offered, look further and deeper into these other offerings and then make the decision. Okay, hope you got a lot of value out of this. The 3 principles of highly successful mortgage qualifications. Thanks for tuning in today, and please don't forget to subscribe for some more valuable mortgage qualification tips. Take care.